Everybody's been buzzing about this rebound in the housing industry, but is it the real deal? Of course, home prices are up 8% over the last year, but my next guest suggests that this isn't the result of a normal housing recovery. Ed Pinto is an American Enterprise Institute resident fellow and former Fannie Mae chief credit officer. Ed, thank you for joining us.
Pleasure, thank you.
In an opinion piece in today's Wall Street Journal, you warn of what could potentially be another housing bubble. Go on.
Well, the problem is, yes, house prices are up 8%, but incomes are pretty flat. And the only way that house prices can go up if incomes are flat is for interest rates to go down. And thanks to the Fed, that's exactly what's happened over the last year. So the monthly payment that people are making for these more expensive houses is identical to the monthly payment it was a year ago, except they're paying 8% more. This is not a healthy recovery. And when the Fed has to unwind this, they're creating potential bubbles in the stock market, the bond market, and in housing. When they have to eventually unwind this, it's not going to end well. As I indicated, if interest rates go up to just 6%, which is a pretty benign number given the last 20, 30 years from today's 3.5, either incomes have to go up by a third, or house prices have to come down by a quarter, or you have to loosen lending standards, and we've already been down that road. What happens when you loosen lending standards? So there's not a good exit here.
We certainly have been down this road before, and you make a great argument. But as you know, the news headlines of late have been concerned over the stock market bubble being created by the wealth effect that the Fed has created, and it hasn't been along the lines of the housing market. Is that troublesome to you, or do you just see parallels in this?
I see parallels, and I think it's this wealth effect which was really utilized to excess back in the early aught years by the Fed when they, by design, tried to pump up the housing market in the early aught years, and the Fed minutes that have come out in the last couple of years show that that was the goal. They wanted to create this wealth effect to allow people to tap their equity. In this case, I think what they're hoping to do is reduce the amount of underwater mortgages. They want to give people the appearance or the feeling that they've got more money in equity, and so they might move up to a larger house. But again, it's an illusion because they're doing it with the same monthly payment. They're really doing this like automobile lending, where you walk in and you don't ask the price of the car. You say, what's the monthly payment? Well, they're doing the same thing in housing. That just doesn't make any sense.
So begs the question, how could the Fed navigate an orderly wind down? Should interest rates come up sooner than they've been suggesting or targeting they will? Should they take the foot off the gas pedal? This is the Fed before, as they've said before, unemployment falls to 6.5%. What do you think?
I think the Fed's got to start, backing off on the pedals that they're using. They're using quantitative easing. They're buying U.S. Treasuries and agency securities every month, $85 billion. They're keeping interest rates very low. They're punishing savers, and they're enabling not only the stock market and the bond market and the housing market, they're enabling Congress to borrow $1 trillion every year in new debt and pay $8 billion. The current Treasury rate that they pay on average going forward is 0.8%. So you do the math on $1 trillion. It only costs Congress $8 billion to put on another $1 trillion of debt. They are promoting all kinds of bad practices here. They should just start backing off.
Well, we certainly appreciate your warning. Ed Pinto, once again, we were listening carefully, and we're going to catch up with you again soon because this is something worth following up on indeed.
Thank you. Bye now.